They told you it was progress. They called it modern monetary policy. They said it was the only way to manage a complex global economy. They said the money in your pocket, the dollars you sweat for, the savings you pray won't evaporate, is backed by the full faith and credit of the United States. But what if that's the most sophisticated, devastating lie in history? What if the financial stability you were promised is merely an illusion, meticulously maintained by a small cabal of unelected power brokers? What if the inflation stealing your purchasing power, the debt shackling your children, and the job instability that haunts your every move is not an accident, but an engineered consequence of a system designed to fail you? This isn't just about the 10 trillion lie in the headline. This is about the total control of a $400 trillion global financial machine. And it all comes down to a single, secret mechanism designed to bypass every safeguard. We're not talking about gold standards or simple budgeting here. We're diving into the dark heart of the global economy. If you think your life is getting harder, it's because the game is rigged, and the secret weapon of the manipulators is the derivatives market and the shadow banking system. Where are you watching this unfiltered truth? Drop a comment below right now. Don't just watch this, subscribe and turn on notifications, because this is the information they hope you never find. To understand the lie, we must first look at the history of the confidence game. The concept of value itself has always been a political weapon. Look back at the Roman Empire. Emperors debased the coinage, shaving the silver off the denarius and mixing the remainder with base metal. Why? To fund endless wars and extravagant projects without raising taxes on the wealthy elite. The metal was replaced by a promise, until the currency collapsed, taking the empire's economic stability with it. Sound familiar? We replace the gold in our currency with paper. Then we replace the paper with digital entries. The principle remains the same, a promise stretched until it snaps.
Now fast forward. The 20th century gave us the gold standard, a fragile tether to reality. That tether snapped in 1971 when President Nixon announced the temporary suspension of the dollar's convertibility to gold. Temporary? 50 years later, that suspension is the permanent operating system of the global economy. This shift didn't just change the money, it changed human nature. It eliminated the natural check on government spending. It meant politicians and central bankers could create money out of thin air with no physical, finite restraint. The debt ceiling became a political comedy show, not a real guardrail. In the 1920s, the financial world went mad for leverage, buying on margin, speculating with borrowed money. The official financial system was regulated, but a parallel, unregulated market boomed, fueled by speculation. They called them pool operations, coordinated manipulation schemes that blew up in 1929, ushering in the Great Depression. Sound familiar? Today's shadow banking system is those 1920s pool operations on steroids, operating on a global, digital scale far beyond the reach of any single regulator. The official banking system is the visible tip of the iceberg. The shadow banking system, the dark, cold, 90% below the waterline, is where the real risk resides. It's composed of hedge funds, money market funds, specialized investment banks, and, most critically, the labyrinth of derivatives markets. When money creation is infinite, the chase for infinite returns becomes a moral imperative for financial engineers. Sound familiar? This pursuit, this greed, is what led us to the big reveal. The entire structure of global finance, the official banks, the pension funds, the national budgets, is built upon a single, volatile pillar. This pillar is the derivatives market. In the 1990s, regulation was seen as an impediment to innovation. A powerful push was made to exempt complex financial products from regulatory oversight. There was a key decision, a vote taken in the shadows of Washington, D.C., that became the legal black hole for global risk. This decision essentially legalized a casino on a global scale, allowing trillions of dollars in unregulated bets to proliferate.
This mechanism had to be kept secret, or at least complex enough that no average person would ever look for it. The perfect vehicle was the interest rate swap. Seemingly benign, this instrument allows two parties to exchange interest rate obligations. In reality, it became the lubricant for the entire shadow banking system, enabling massive, unchecked leveraging. banks could suddenly take on far more risk than their balance sheets showed, moving liabilities off-book into special, opaque vehicles. But who was the architect? Who was the single figure that drove the legislation, the one who leveraged his immense political and financial clout to ensure this legal loophole become a permanent fixture of the global system? The person who, more than any other, is responsible for the financial weapon of mass destruction that is the modern derivatives market. The truth is always hidden in plain sight. You won't believe his name, and the actual evidence that links the modern derivatives complex to the permanent weaponization of the US dollar is crazier than you think. The architect was Senator Phil Gramm, who championed the 2000 Commodity Futures Modernization Act, CFMA. This single piece of legislation ensured that over-the-counter, OTC derivatives, the complex, customized contracts like those infamous credit default swaps, CDSs, were exempt from regulation by the Commodity Futures Trading Commission. Gramm later went on to work for a major Swiss bank that benefited directly from the deregulation. That is the moral hazard that birthed the crisis. Now let's break down the hidden mechanism, the shadow banking system, and the 400 trillion derivatives nightmare. Think of the official banking system as a car with an engine governor, a limit on how fast it can go. The shadow banking system is that car with the governor removed, running on rocket fuel. It uses leverage, borrowing money to amplify returns, to turbocharge everything. The core of the lie is rehypothecation. This is the financial trick where a bank takes an asset, like collateral, given to them by a client, and then uses that same asset as collateral for its own borrowing. It's like checking your coat at a restaurant, only for the coat check person to use your coat to get a loan from the bank, which then uses the coat to get a loan from another bank, and so on. In 2007, the total rehypothecation of collateral peaked at $4 trillion in the US financial system, a dizzying web of recycled collateral. This mechanism is amplified through the OTC derivatives market. These are contracts traded privately without a central exchange or oversight. The size is staggering. As of early 2023, the notional value of all outstanding derivatives contracts globally was estimated to be near $610 trillion, more than 7 times the annual economic output of the entire planet. But the true, dangerous part is the credit default swap, CDS. A CDS is essentially an insurance policy against a bond defaulting. The risk? You don't have to own the bond to buy the insurance. This allows for parasitic finance. A speculator can bet against an asset or an entire nation without ever having skin in the game. This creates a vast, interconnected web of toxic exposure. Think back to the 2008 collapse. The mechanism was the mortgage-backed security, but the real dynamite was the CDS that insured the MBS. When the mortgages failed, AIG, a massive insurer, didn't have the cash to pay the claims on its $440 billion portfolio of CDS contracts. The entire global system froze. The US Federal Reserve had to inject over $16 trillion in hidden loans and guarantees into the global financial system between 2007 and 2010 to prevent a total collapse. $16 trillion, and that number was fought in court to keep secret. This system is built on engineered destruction. The complexity is intentional. It ensures that when one part of the shatter system collapses, the fallout is instantaneous and global, forcing the central banks, the ultimate arbiters of the lie, to step in and print more money to save their financial partners. This is not rescue. It's a self-perpetuating mechanism of control and wealth transfer. The lie is this: the shadow banking system is not a bug, it's a feature. Based on this permanent, unregulated, and self-perpetuating derivatives market that requires guaranteed central bank bailouts, the big reveal. The derivatives markets, deliberately shielded from regulation by the Commodity Futures Modernization Act of 2000, act as the global financial system's permanent, off-balance sheet nuclear reactor. Their unchecked, leveraged proliferation forces central banks to constantly inject liquidity, effectively printing money to monetize private sector risk.
meaning the system is now structurally incapable of functioning without an endless inflationary supply of new currency, making a return to stable, non-inflated fiat money mathematically impossible without first accepting a global, cascading deflationary collapse they will never permit. The inflationary theft is permanent.
They survived 2008 by kicking the can, by using taxpayer money and freshly printed currency to patch the holes in a rotten ship. But the stakes are now infinitely higher. The system is no longer just domestic. Risk is transferred across borders in milliseconds, and the shadow banking system has grown exponentially since the last crisis. The next collapse will be faster, more global, and far more severe. Every time they step in with a bailout, they steal a piece of your future, replacing your real savings with borrowed time. The final philosophical lesson here is about denial. The system works so long as the vast majority of people remain in denial. Denial about the true value of their currency, denial about the inherent risk in the leveraged debt structures, and denial about the motives of those in power. They profit from your lack of knowledge. They rely on your complacency. Your skepticism is your greatest asset. Your financial literacy is your only defense. Do not trust institutions built on borrowed time. If you're skeptical, if you're awake, hit the like button and share this video everywhere. Spread this fire before they try to extinguish it. Are we wiser now, or walking the same path in better suits?